All right, the word of the day today was capitulation. Was today the capitulation day today? So it was a great move to the downside. Big, 4%, 5% on the NASDAQ. Huge moves. Has a lot of hallmarks of just a broad, washout sell-off. Was that it? So I'm going to break it down and take a look at, as well as show you what I posted online on Twitter. If you don't follow me on Twitter, I put a lot of stuff out there today, so make sure you do, at DavidSettle42. But we're going to take a look at whether today was capitulation or what should we expect. We were expecting a bounce. Has that changed now because of their drop today? So we'll talk about that. What's driving a lot of this action? A kind of a one of these asset classes that finally did move in the direction we expected when it hadn't been for the past really few months. A couple asset classes actually that did that. And then a few of these shoes for corrections to actually be completed. A few of shoes that need to fall. We'll talk about that. And then our trade idea is a stock that really got hammered. A lot of consumer stocks getting hammered. This was one of them. How do we trade a stock bearish that's already dropped so much? So we'll talk about that too. So let's go ahead and get started. Today is Wednesday, May the 18th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And you notice that bullish near-term run didn't... Now, granted, that bullish near-term rally is not done. It did drop out of bullish territory, did not get into the lower half of the chart or in bearish territory, and that's when it's done. So theoretically, we could bounce back up here and still be on the same near-term run, though. I mean, we'd have to have a significant bounce because tomorrow, even if we just have like a kind of a nothing day tomorrow, with smaller range and just kind of hang around maybe the lower to middle end of the chart, you're still going to, I mean, the continuation is going to bring that near-term line into bearish territory. It would take a really significant bounce to the upside. We're down 7% still. We're very persistently below the 30-day moving average here for quite some time. That whole moving average is staying really, down. Like you can see, the parabolic stars are dropping pretty rapidly, which is usually the case after you flipped it to the upside. We are down in the 10th percentile below the 200-day hull, so very low relative to where we've been here in the past, about 8.25%. We're still above, at least the Hakinyashi close is still above the 20-day hull. So now, granted, you're going to get a pretty bearish candle tomorrow because the open is going to be about 4,000. We're trading at 39.23. So you're going to get a pretty decently sized bearish candle. It's a matter of how bullish we end up getting, whether we can get back above 4,000 by tomorrow. We did drop 165 points today, and from 4,000 down to 39.23 is only about 75 points. So in theory, we can jump back up. And like I said, the parabolic star is dropping, but you notice again that hull has been red for so long without a meaningful move to the upside. So one is coming because the hull when you got a 20-day hull, you typically will stay red or green if you're trending to the upside for 20 days before you at least get a small little dip. Some of these dips there. So very, very long pullback, and even when you get these kind of small little dip, moves in the parabolic SAR, flipping the other direction, then you flip right back. Usually the second one doesn't last very long, and this one has. In fact, you're going on 1, 2, 3, 4, 5, 6, 7, 8 days. You're nowhere near, so it's going to probably at least be 9 or 10, which is again, very, very extended. Just in a move up by itself, much less being kind of the second end of that leg. So needless to say that we're still strongly bearish. We'll see. We did not get below the low point here on May the 12th. We did on the NASDAQ, you notice, or at least we flirted. We came closer, to it on the NASDAQ. Much more bearish, stayed down 5%. Obviously, the NASDAQ did not get above that 23% retracement, just barely did. So we're still back down in this noisy area. This is a very big gap between the 0 and 23% line, which makes big moves seem pretty noisy, right? Because really, nothing really happens until you break the 0 line or you break the 23% line. So otherwise, you're just kind of in a noisy area. That's a big noisy area because of, again, how big the moves are right now. The Russell 2000 did not go down as much, only down 3.5%, nowhere near, like a lot further away from the close. The near-term line did get out of the reversal zone, or bullish territory, but the intermediate line actually is out of the lower reversal zone. So, so again, you got light green shading. It's not the most bullish pattern. You're still obviously pretty darnly, strongly bearish, but at least you got light green shading here because of that intermediate line that you don't have. Definitely don't have on the NASDAQ, which is at the 15th percentile down there in the bottom right, and then the S&P at the 18th percentile. So a little bit of an outperformance on the Russell 2000, again, relative to its peers. When you take a look at some of these long-term charts, you can see the bearish candle that we're getting on the S&P this week. As bearish as we are, you notice the Hakinyashi close is barely lower than the prior weeks, and we are not closing anywhere near below the low point, which is what you need to be bearish. So you can see like and that differential is moving up because the bodies are getting smaller. So we're gonna be gradually moving towards this kind of move. I don't think it'll be the same size, but we're gradually moving towards that kind of move, despite today's rally, or excuse me, significant decline. You see that as well on the Russell. The Russell's even, because again, it's been more bullish. You can see the closes are right on top of each other. That's very typical of, the end. See the end, when you get bearish, and then you don't close, but you don't get a lower Hakinyashi close, you tend to move towards transition. Now we didn't bounce back up there, but at least that's when you start to move towards transition. So the Russell is getting there, 2 more days left, and then the NASDAQ and the S&P, you can see, are still kind of working their way in that direction. It's slightly lower lows, but definitely not a lower, closing below the prior week's low point. Looking at the 3 green arrow chart, you have 2 green arrows still, despite the drop today, on the S&P 500, on the Qs. You have 1 green arrow still on the diamonds, and then you still have your 2 green arrows. So that kind of shows just how bullish we were, that a day like today doesn't put you back into pink shading here. So when you get big bullish moves, you're going to get big bearish moves that follow them. Like you're just in this mode right now where the candles are big. They're three. And the reason why is because your VIX is big and your ATRs are big. Your ATR is up to 2.75%. That's a high number. So when you're at this number, the ranges are big. The average, the ATR right now is at 10 points, 11 points. That's average. And today we're slightly above the average. So we're going to get big moves, to the tune of 2.5% or higher of the rally. So we're going to get of the current price, excuse me. So we're going to get big bars to the downside, and they're going to be followed up by big bars to the upside. So don't be surprised if we don't move up. Maybe not tomorrow because of the momentum we got today, but don't be surprised if we don't move up rather quickly, probably by the end of the week, to get back up and kind of throw everybody for a loop, trying to figure out what today was all about. We did get above the 8-day yesterday. We did not get above the 17-day, and we got all the way back down. But again, not getting to new lows. The MACD is actually still above its moving average. So stochastics is still above its moving average and still rising. So again, grain of salt. I know it's a big move. I know 5% is a big number, but big grain of salt on how bearish this is, because it's not really, especially on IWM, we're not that bad. I mean, we're barely below the 8-day moving average on IWM, and the MACD and stochastics are moving up a lot better. When you look at the DMI for SPY, back above 30, back below, still below 20, so your ADX is still rising. On IWM, we're barely above 25 and below 20. So again, not nearly as bearish. Looking at the RSI and the CCI, let's look at the NASDAQ 100, below 40, easily still below 0. The Russell 2000, on the other hand, barely below 40 and barely below 0. So you can see not nearly as bearish. From an Ichimoku cloud, we're well below the cloud, way below the cloud. Very mature trend strength there. IWM, same thing, very mature trend strength, but you can see we're barely below that green line. Let me show you again where SPY is, well below the green line, right? So So again, you can see the relative strength right now in small caps. I mean, it's still dropping. Still 3.5%, still a big number, but it's better than 4, right? Than what the S&P had, and definitely better than what we saw. You can see today's drop did not get you down below the lower band. The bandwidth is still falling. It did get you in the lower quartile, but did not get you below that lower band. You can see that from a Keltner standpoint, did it get below the Keltner channel? And you can see no, it didn't. So again, as big of a move as this was, it did not get below the Keltner channel, which you trend when you get below the Keltner channel and above the Bollinger bandwidth, and the bandwidth is still falling and negative momentum. So I think today is more of an outlier than anything. It's a big outlier, but keep in mind that we had rallied pretty significantly. When you look at it on this basis, we filled in that gap, and you knew we were going to fill in. That's not a runaway gap. So we filled in that gap. We filled in this gap. The rest of that gap from yesterday, we still have to fill in today's gap. So, so I think this was just a gap fill, and I think now that we'll just rally back up off of this. I don't think we'll go up 5% tomorrow, but over the next few days, we'll work our way back up off of. We might open up down. In fact, it would be ideal if we did open up down, because then we could gap up instead of opening up higher and then not having, you can see, not getting enough momentum throughout the regular trading session to keep it going, right? So you had the biggest move overnight, and then you just kind of held it. Same thing here. You got a big move overnight, and then you just kind of held it during the regular trading session. You'd like to get that big move when you have the big volume associated with it. So it'd be nice if we did gap down tomorrow, probably down to this 385 or in that area, and then we're at 391, so a little bit of a gap so far. But if we could gap down there, instead of gapping up, gap down, that would be really good, because then you can fill in that gap right away and then start to work your way up over the next few days to get back and filling it, which I believe we're going to be filling in that gap sooner rather than later, this morning's opening gap. Obviously, today's move was big volume, big range, 13 points, 117 million shares trading hands. So that number in context, 13 points is off this chart, 130 millions up towards the top. These are big numbers, big ranges, big volatility. The VIX is above 30 again, but the VIX is only at 95%. So the VIX, even though the VIX is relatively high, the VIX 3M is still higher. And I've got a lot of tweets. So if you follow me on Twitter, here, give me 1 second. If you follow me on Twitter, I tweeted out a bunch today about the VIX and capitulation, because that's a very hot topic right now. Are we capitulating? Was today a capitulation move? Now, I do think we'll bounce off of this move, but I hardly think this was capitulation. So make sure that you check out, here's the put call index. There's quite a few things here I talk about capitulation. The VIX, for example, here's all the capitulation moves on the VIX in the prior 5 corrections. You can see their candles here. I've got them highlighted. You can see all their candles. Pretty decent. This was over 3 periods, and then this one. This is our candle so far, right? You can see that this does not look anything like all these others. This is where we ended those capitulation periods. You can see we got well above 100% on all of them. And this is where we're at right now, below 95%. So not a capitulation at all. And so there's other charts here, so check that out. Again, I'm at David Settle 42. So at David Settle 42, make sure that you click on that follow button. There'll be some kind of follow button there, and you can be able. And the more you just click on the likes, when you see if you want to see my stuff, and when you do see a tweet of mine, hit the like button, and then that tells Twitter I want to see more of his content. That's how you can make sure you see what you want to see on Twitter and Facebook, for that matter, by clicking on the likes. That goes a long way, and we really appreciate it, because it helps us too get. I have this however many followers, whatever, 10,000. I don't have 10,000 views on these tweets because it doesn't always get to everybody. But the more engagements it has, the more it gets out to people. So I appreciate that for people who like and retweet. So not a capitulation move. Today was a great drop to the downside. It's got a lot of people talking on TV. There might even be a markets in turmoil segment today. Who knows? But the reality is, it's not like I fully expect that we will continue to bounce up. We'll fill in this morning's gap. It's not that big. It's only a big deal because the ranges are just so big right now and volatility is relatively high. But it's not that big of a deal. We haven't broken down below support. We haven't, we're not falling off a cliff. We didn't even drop and lose everything we had gained over the past 3 sessions. So I don't see anything more than that. And I think, if not by the end of this week, definitely after expiration, you'll start to recover a lot of today's losses and then some, and still move our way back up towards that resistance level we talked about in our last market outlook video. So what do you think? Do you agree with that? Do you disagree? Now let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback and let us know you like our stuff. If you don't, you can do it right now even while you're watching. If you don't like it, of course, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon that takes you to our Market Outlook live page. Every Monday, Wednesday, and Friday at 3:30 Eastern Time. On this page, I do a quick 10-15 minute live video. I take a look at all the trades we've done in prior Market Outlook videos. In fact, we closed a couple of those today. So we talk about whether we should stay in them, close them. We also put on today's trade idea that you hear at the end of the video. We already put it on today, and we did it during this. You can check out all the archives as well. You can also get to it by clicking on Live Trade Review in our main menu. Come down here, you can see our upcoming classes. Click on View More. That takes you to your calendar. Our calendar here, all of our upcoming classes the rest of the month, as well as 4 years worth of recordings, including today's classes that we have posted here. You can also get to that by clicking on Trading Rooms up here at the top. Come down to the bottom, click that heart. It opens up this tab. Hit that like button there. Almost got to 100 there. Let's see if we can get to 100 tonight. Click on that thumbs up icon. Takes you to this page. Click that like button. Like I said before, this really helps us out because it gets our content out to more of our followers. It also benefits you because Twitter will promote content to you from accounts that you engage with. So we try to make it really easy for you to engage with us right here. All right, let's take a look at what's driving the price action. It's very interesting. Last 3 months going into today, commodities are still, before today, commodities were up 20% on a 3-month basis. The dollar was up 8.25%. Everything else down 4% or more. Emerging markets getting beat up by that strong dollar. Q's down. Bonds were down until today more than emerging market. In fact, going into yesterday, bonds were down the most out of all of these. And of course, today was probably the first day in a while that you finally had a true risk-off day where bonds actually participated and rallied. Went up over 2%. Gold and the dollar were both up. Gold obviously underperforming treasuries and global bonds because of that strong dollar, but at least they outperformed equities as well as corporate bonds. And you can see too that commodities, which have been bullish with the dollar, which is not very common during kind of risk-off modes, which we've been on for the last 3 months, did come down along with emerging markets. You can see emerging markets, despite more strength in the dollar, emerging markets outperforming U.S. equities pretty clearly. Again, there's your 5% drop on the Qs there. So pretty much a risk-off day when you look at how bonds have performed. They're so bearish. I've said before and probably I've said it on this video, but I've said it before too in our classes, that corrections don't end until bonds participate, right? Bonds have to participate in a risk-off move, and until that happens, you're still going to be in correction mode. Well, bonds still haven't really participated, and today you've gotten above the 8-day moving average, what you did over there too. on whatever day that was, May the 11th, so a week ago, we got above the 8-day moving average, and we didn't stay there. We fell the next 4 days in a row. So we need to get above the 8-day. Now, this MACD has been converging to the upside. Stochastics has been trending to the upside. So while we've been trending down on MACD, so there's divergences forming here. There's an opportunity. We're more below the 200-day moving average than TLT has ever been. Again, there's more limited history. It doesn't go back like decades. It only goes back, a couple of decades. But so there's a pretty good history. It's just not, forever. But still, that's the furthest below the 200-day moving average it is. We're well below the value area in the past 1 year, well below the point of control. So it makes it really easy for it to pop up once there's demand. Once you get to the point where people are willing to step in and buy. And so again, you can't be fully risk off until people move out of equities into bonds. And obviously they've been moving out of equities, and you got a little bit of a piercing line pattern. And it looks like the MACD is bottoming out on the weekly chart. So it looks like we may be finally starting to head in that direction. You got to get above, though, that 17-day moving average and stay there, right? That's what will get the MACD really going and potentially move it back up to the upside when you get above that 17-day moving average. So that's bonds. The dollar, interestingly enough, continues its rally, and it's going to be kind of, again, interesting to see just how bullish this has been, but you're in a convergence mode there with the MACD and stochastics falling, even though you're still above the 17-day moving average. So that's going to be interesting to see what kind of pattern that develops. A lot of the dollar strength has come from yen weakness. This is one of the biggest parabolic moves the yen has had, but you can see the last week has been really bearish for the dollar versus the yen. The yen's a safe haven asset class. So if the market's, this is one of those shoes to drop. If the market's going to correct, the yen rallies. The yen is a safe haven in the currency world. And so, if we're going to really get a correction and be done with it and get a full-on correction, you need to see the dollar underperform relative. The dollar underperform relative to the Japanese yen, and you're starting to see inklings of that with the break below the 17-day moving average, and you can see these candles with the MACD peaking and rolling over on the weekly chart there. Bitcoin had a pretty significant move today. When you look at Bitcoin, 29,000 is a really important level. It's trying to get there. So we did get a long lower shadow. We did get below it, but didn't finish very strongly below it. So you got the long lower shadow and rallied back up. But if you look at the engulfing pattern today, you're still below the value area. So you hit some resistance. You're flirting with getting back below 29,000 and trading in that range. That would be back below support. This is some Fibonacci support levels. So if you do get below that support, again, there's no volume below it. Again, this would be a reflection of what's going on from a risk appetite standpoint on the very far end of the risk appetite scale. And you can see very little volume for you to finish the correction in Bitcoin, if not, come down towards the pre-COVID high points into 2019 when we were sitting there at 12,000. That would obviously be a significant change for a lot of people who were getting into Bitcoin over in this area, thinking it was the next big thing. And even at 12,000 would still be a really good return off its COVID lows. Then at 12,000 would be a really good return off of this bear market low and the end of the fourth quarter 2018 when we started a bear market that ultimately peaked with COVID. But that was a pretty significant low point there for equities too, right? That was a correction for equities in the fourth quarter 2018. So, we were at, 3,000 over there. So that would be still a 400% return if you got to 12,000. So it'd be well off of its highs, but it'd still be a really good return. Same thing, you've seen the same thing with ARK. ARK is obviously well off of its highs, but when you look at its returns over since it started, you're still well off of these levels from 21 up to 35. In fact, coming off of its early 2016 lows, which is the end of that correction, the correction that we had there, ARK is still up, 190%, almost 200%, and that's about a 30% annualized return. That's still a pretty decent return off of, what would that be? 2.8 of 2016. If I were to do a comparison chart here, comparison of the and do it to SPX off of this 2.818. And here, let me do this. So here we go. So, and then let's just go over here from 2.816 up till now. You're up. There's your ARK, there's S&P 500, and then there is your ARK investments and the pullback it's had from that level. So pretty decent move for ARK on a relative basis compared to SPX going into that level, and you can see the drop it's had. Still up almost 200%. SPX up 500% there. Off that 2016 low point. Again, you look at it here, SPX. Actually, SPX is up 111. That's what I was going to say. I don't think it was up 500% off of that level. Let's see here. Let's go here and go. Yeah, I was going to say, I thought that 500% was a little bit of a big number there. Shows percentage, 111% compared to ARK investments, which is 178%, despite coming down from its highs where it was up 1,000% off of that level. So that it would still be a really good return for Bitcoin to get down to that point, but it would be obviously well off of its highs, and it would be in its own bear market. And that would be a reflection of that end of the risk appetite scale being in its own bear market, and that eventually gravitating towards the safer end of the risk appetite scale, especially your dividend stocks that are still haven't started their correction yet. Down 2.5% today. A lot of these kind of companies getting hammered today, but you can see barely below the 17 week, and just barely breaking below the 17-day moving average today. Right, so you're still above the 200. You are in kind of this little intermediate decline mode, but the dividend stock, the risk off, the bear markets, the correction mode hasn't come over here yet, and it would be the last one to experience a correction. Again, very similar. We think that these stocks don't correct, but even in 2018 when the broader market corrected, so did these stocks. Right, they dropped too. Everything does. They don't drop as much, and they drop last, and that's what we're seeing right now. And so we're, there's a whole spectrum of risk appetite, and we're seeing, Bitcoin, ARK investments, those types of stocks, innovation type stocks, that all got pulled. A lot of those future returns getting pulled forward during COVID. They're obviously, towards, in bear market mode now, definitely full on correction mode. Whereas these stocks, dividend stocks, are barely in pullback mode and just kind of starting. And then you have like the mega cap tech names that are just starting the correction, like Apple. Apple is just barely starting its correction mode. Here's the weekly version of this. Barely getting down there, and lots of room to go to get to that point. Tesla would also fit in that category too. Speaking of that, let's take a look at consumer stocks, discretionary and staples, just not having a good day today. So if I take a look at the sector rotation here, and let's just look at today, May the 18th. You can see staples and discretionary, just anything consumer is getting. Inflation rates are hitting. They're hitting hard. Utilities are holding up. Their safety trade only down 1%, but these two got hammered. When you look at their 12 grid version of this chart, so you're going to see staples down here and discretionary at the top. And look at staples breaking down hard. Real estate's already down hard. Staples now down hard. Again, the last shoe to fall. So you got some dark pink shading, red lines. Energy getting a kind of an evening star candlestick patterns. Materials and industrials dropping back down. We are again, when you're in correction mode, everything falls. When you're in pullback mode, not everything falls to the same extent. But when you're in correction mode, everything falls. So you're getting dark pink shading or close to it and red lines across pretty much everything. It looks like, you know, Staples definitely going to fit that criteria for a while now, along with real estate. And then now it looks like energy might end up joining that party too. All right, now let's take a look at our trade idea of the day. Let's take a look at McDonald's. McDonald's dropped hard, like a lot of these stocks, right? Down 4% today, one of the biggest drops. You can see on the daily chart, you know, that's pretty decently down. Got a cluster, down 7%. But if you look at it on a weekly chart, you can see it kind of looks like it's just barely getting started, right? I mean, we had a pullback. You know, if you were looking at like corrections versus pullbacks versus bear markets, right? So let's go here. You know, we had our pullback, and it actually went through the 50-day moving average. Then you had your bounce. Here's your failed pullback bounce. We are now in correction mode, which means you can expect that it will get down towards 210, down towards the 200 or below it. See, it went below it there. This was actually a pullback because you never did have a failed pullback bounce. But so you had your, I mean, we went below the 50 there. So you could go below. You went below the 50 on that pullback over here. You could go below the 50 on this decline. You can see the MACD is back below its moving average. Stochastics is back below. So it looks like on a weekly basis, you're kind of just barely getting started. All right, when you look at on this chart, the other weekly chart we use, you can see you're just getting the 10 weeks is barely crossing below the 40 weeks. So the PPO has gone negative. You got a bearish candle. Hakinyashi's closing below all these lows, a red arrow. So it kind of, again, looks like you're kind of just barely getting started. From a three red arrow standpoint, you can see that we got 3 red arrows here and a pretty decent amount of volume. So you got pink shading. Obviously, all these oscillators are going to show bearish signs too. The DMI breaking above 25 for the first time in a while. The RSI and the CCI, you can see also breaking down below 40, below minus 200 on the CCI. Looking at the Ichimoku cloud, you broke below the cloud after being above it, well below. You got an intermediate trend strength going down there at the bottom. Looking at the Bollinger Bands and the Keltner channels, when you look at both of them together here, you can see we actually broke below both of them, right? So we hadn't been below both of them. The bandwidth is rising. You broke below the band and the Keltner channel. You don't have even green. You don't have your first green dot yet, which is when the bands go outside. That usually starts the trend. And so, like, again, it kind of looks like you're just getting started here to the downside. The problem is how much downside. And so what we decided to do on McDonald's is just do a bear call spread, but at the money. So selling the at the money bear call spread, selling the 230, buying the 240. So it gives you, you know, kind of for a normal amount of return that you typically get on these short verticals, but for half the risk, right? This is half the risk of what we normally put on to get that return. It's actually a little bit more than normal return and a little bit more than half the risk, but still, that's a pretty decent reward risk ratio. And now really all we got to do is get below 230. So I don't care how much further it goes down as long as it eventually gets below by June expiration today's low. So it gives an opportunity to bounce back up off of today's low, right? In the short term, we might move our way back up here as long as it ends up in June back below 230, which is what the Bollinger Bands, you know, have priced in. The Bollinger Bands have priced in the idea of moving up and down. So, you know, the current, you know, we can go up and down and then still finish at 355. And we'd be fine. It just has to get below McDonald's. It has to get below this 230 level. So down to 208 is where it has. And again, there's no volume here on the 2-year chart. And if I look at the 1-year chart, excuse me, if I look at the 2-year chart, there's not very much volume down till you get to 210, 220. So we have a good opportunity to get a really good reward pretty quickly. We might be able to get 50% of maximum gain pretty quickly on this before we move on to another trade. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also, like us on Twitter and Facebook. Join our website at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.